Thanks for tuning in to Talking Point. I'm your host, Niraj Shah. Now, JP Morgan has written a very interesting note which looks at the Indian mining, metals, and resources space from a next decade perspective. And they believe that on a conservative demand estimate and a bullish supply assumptions, India will turn amongst the top two importers across commodities in the coming decade. It's a very interesting call, a long-term call, and well, in a way, challenges assumptions may be made by a few people, but if it turns out to be true, actually turns to be a very bullish scenario for investors within this space in India, simply because if the supplies do not meet the demand, then the prices of the end product and the demand for the end product remain bullish for a decade, which is a big thing. Pinakin Parekh, who's authored this report, he's director metals and mining and resources, I presume, at JP Morgan India, joins us right now on the show to talk about his note and some assumptions around that and the implications thereof. Pinakin, so good having you. Hope all is safe.
All is safe. Thank you for having me over here, Neeraj.
Now, the pleasure is ours. Pinakin, so let's start off with one of the assumptions that you made in the report, which is that the decade gone by has been, I mean, that's not an assumption, the decade gone by has not been the best. And you say in your report, if I'm not wrong, that it forms the base for an upcycle. What gives you the confidence that the down cycle that we've seen in the past decade is actually laying that base for an upcycle? Why can't the down cycle, as we call it for the last decade, continue into the next decade?
Sure, Neeraj. So basically, what we have looked at is that when you look at any upcycle and down cycle, it's an interplay of demand and supply. What happened was in the last decade, demand weakened marginally from where it were India's growth rate has been. But we also saw the bunching up of supplies coming through, whether it was in steel, whether it was in aluminum. So demand weakened at a time when there was overcapacity in many of the subsectors. You had global environment which was weak, and that created a down supply. Now, when we are looking into the next decade, our view is that India's structural demand tracks remain steady. You can be very conservative, but India's demand will still grow by 5 to 6%. But the change that we are seeing is on the supply side. Now, last decade's down cycle has meant that balance sheets are very weak, industries have been consolidated, and there is very little appetite for companies to add capacity. And the point we're trying to make is, look, there is no greenfield projects which companies are, working on, whether it's steel, whether it's aluminum, whether it's refining. And that eventually means that sometime over the next few years, demand starts outstripping production and India turns to imports. And that is what effectively we mean when we say the next upcycle.
Right. Now, have you made an attempt to try and kind of figure out what would be the timing of this? I mean, based on the demand supply, as you said, is it are we already in the midst of or the starting throes of the upcycle, or could it happen with a bit of a lag? How easy or difficult is it to time this?
Sure. So this is the question which we have got from a lot of investors that are we too early into this to the trade? Now, the way we look at it is that, look, each of the commodities would have its own demand supply dynamics. In commodities like steel and aluminum, you are already seeing capacity utilizations hit near 100% for the capacities which are operating. And as we get past COVID, as government spending picks up, demand growth picks up, our sense is that steel, aluminum would probably be the first ones of the racetracks in terms of a tighter demand supply dynamics. Refining could flow through with a lag. LNG obviously is surprising on the upside. So on the outer side, we think by mid part of this decade, we will clearly see large imports taking place. But in commodities like steel and aluminum, we should start seeing signs of a tightening market over the next 2 to 3 years.
Okay. And I presume you as I read in the report, there are a bunch of these commodities. You are saying that in the base metals and ferrous and non-ferrous space, we are already off the blocks when it comes to this starting formation of the upside.
Yes, and the reason for that is that if you look at steel, and investors and everybody looks at headline utilization, our view is that headline utilization tends to be misleading because there is a chunk of steel capacity in the IAF induction arc furnace space, which is cold reliant, where utilizations are very low. And they are unlikely going to hit 100% anytime soon. So headline utilizations A can be misleading. B, you have investors are framing their view based on the demand seen over the last few years. And in our view, as we get past COVID, government spending continues to remain robust. Demand could surprise on the upside.
Actually, Pinakin, that was going to be my next question. I mean, with the kind of products which you've written in your note about, it is implicit that it needs large pools of spending. We know that state government finances are very, very constrained, and a lot of people believe that central government too will move from being a provider of finances to be an enabler of reforms to enable the private sector to do the heavy lifting, because even the central government is kind of strapped because of a number of the large population measures that it has had to take. And you yourself mentioned that the private sector has not embarked upon any large capex right now, and the balance sheets are, well, for lack of a better word, stretched enough to not enable them to do so. Where does the spending come from for the economy, which would be the primary catalyst for the demand to move up?
Sure. So one of the findings of our study was the relation of demand to spending by the governments. We have data going back from 1970, and we looked at similar size countries. We did not look at developed markets. We looked at the Southeast Asian countries, some of the European countries, the Eastern European countries, and our conclusion is that when it comes to India, and when we went back from 1970 to 2020, there is a base level of demand which is just supported by urbanization. India's urbanization rate, even today at 35%, stands among the lowest in the world in the large economies. The capital formation that you are talking about, which is essentially fixed asset investment, government spending, capex cycle, does add to demand growth, but it is not the sole driver of demand growth. The point we're trying to make is that if you had both urbanization and fixed capital spending, then you could mirror China or Thailand's demand growth from their journey to $2,000 to $3,000 per capita, when the demand growth was 8 to 10%. We have taken a conservative view. We are saying that, look, India's urbanization stands at 35%. In the next 10 years, it just mirrors the growth rate of the last 50 years. It will still end up at 39%. And that urbanization will still drive a minimum 5 to 5.5% demand growth. On this, if you have an overlay of state center spending, you have an overlay of companies doing capex, then this demand growth could surprise at 8 and 9%. But our view is take a conservative view of demand. It still means that you will require 50 to 40 to 50% more commodities across the board.
So, in effect, you are saying that on conservative estimates of urbanization, conservative estimates of demand, and bullish estimates of supply, we will still be stretched on the capacities, and therefore large imports are a certainty.
Yes, that is the way we are looking at it.
Okay, okay, that's interesting. So tell us, in your assessment, Pinakin, in the spaces that you're tracking at all times, if indeed the country has to depend on imports in such a large fashion, what does this? I mean, I'm guessing that would mean that the demand supply situation in favor of demand is a bit stretched, or in favor, yeah, favor of demand is a bit stretched. What does that do to the companies which are operating in this space? Because we have two or three large players by Indian standards, but none of them, as you say, are even adding capacity. So does that mean that the prices of the end products across board uh, don't really go down too much, even if they maybe move up as per the cycle?
Sure. So basically, there are three implications of this, what our conclusions are. The first implication is that companies which can operate will be operating at maxed out utilizations. And you have seen that in steel over the last few months. Companies which are able to produce are running flat out to meet demand. And that will be seen whether it's in aluminum, whether it's steel, whether it's an LNG importer. Capacities which are operatable will have a very good utilization phase. Second, in many of these commodities, you would move to a premium to import prices business model, effectively because consumers will be reliant more on imports. What it means is that for ready availability of supply, there would be an increasing local market premium. You will see that you're already seeing that in steel. You should see that in aluminum as well. Third and slightly long-term implication of this would be the reaction function of policymakers. If policymakers continue to incentivize capacity addition, that should translate into more policy steps which basically are beneficial for these industries, whether it's a border adjustment tax, whether it's higher import taxes, effectively anything which leads to higher prices and profits for these companies would be positive.
Pinakin, in your assessment, what is the nature of the current government's moves imply? Because I mean, we've seen it in electronics, right? The PLI schemes, and I think it's happening in specialty chemicals. It's probably happening in pharma across, wherein there seems to be a drive to try and reduce the import dependence. Would you reckon that that would mean that if anything, if the demand is so high, the government or the powers to be will make it possible in all fashions to ensure that the domestic industry stays competitive and gets the impetus to set up higher capacities?
Sure. So if you look at the steps that the government has taken over the last 2, 3 years, they have been extremely supportive of industry. And starting from whether it was a minimum import price for steel, to higher import duties, to steps like cutting the corporate tax rate, to even commercial coal mining. Right. If you put all this together, on one side, the government is talking about self-dependent Atmanirbhar Bharat, pushing to reduce imports, and on the other side, it is incentivizing and creating policies which, in the long term, would make it more profitable for companies to set up capacities. All the steps are in the right direction. And yes, it's a question of time, before companies have balance sheets which are ready when they start looking at projects. What is still is going to be a constraint at the end of the day is going to be land. Land is a binding constraint, especially for large greenfield projects, because they require large parcels of land.
Hmm. Okay. Somewhere latter half, I would just want your opinion on what happens to ancillaries of all of these businesses as well. But first, just a broad continuing with this conversation. Um, you reckon that the reforms bit which you touched upon uh, are all conducive to companies getting their attempt, to do some capex, whether brownfield or greenfield. Now, agree, land is an issue, but the government has done some labor reforms of late, which a lot of people are raving about, even on the agri side that have happened. But I'm sticking to our sector and commercial coal mining. Even though the opinion was divided, there are a lot of investors who believe that there is merit in what the new norms on commercial mining are trying to do. What's your sense on both of these?
So starting with commercial coal mining, it's a very, very positive step. And I think over the next week, we should get to know more about details about what commercial coal mines in terms of the winners are. I think the issue is going to be more about the timelines on bringing this mining blocks into production. The 2014 coal block auctions saw delays in terms of securing all the approvals in land acquisitions. And the commercial coal mining, while being a very positive step, I think the test would be to see how quickly the projects
Um, Pinakin, sorry, I seem to have lost you. We'll just try and reconnect that line because it's a very interesting conversation and would be really important to understand from Pinakin Parekh of JP Morgan about what the long-term implications of these would be. We'll just try and get him back in a moment or two. I think that's just happening. Um, Net
Sure.
connection has its issues. Yeah, sorry, Pinakin,
Yes,
we lost
yes,
your answer.
sure.
Can you start off with the commercial mining yet again? I mean, we were
Sure.
starting with.
Sorry. Yes. So the commercial coal mining, the way we look at it, first of all, it's a very positive step. It does open up the sector, and you should see more competition. I think the challenges to commercial coal mining would be the same which was there in the 2014 coal block auctions, which is that after the auctions, how quickly can you get these blocks into production? And that's a function of basically getting all the approvals in place, the land acquisition process. So I think that is where we need to hasten up or speeden up the process. The policy step per se is a very big positive. To the second question of, when do all these steps catalyze for companies to look at setting up new capacities? I think the fact is that the private sector in particular has levered balance sheets. So we need to enter a phase where the private sector companies in many of these sectors looks to reduce the leverage and then starts the capex cycle, which is why our view is that it would take time. It would take time before we start seeing companies go for capex, at least in this space.
Yeah. I think our conversations with the management also seems to suggest that. Pinakin, just one quick follow-up on the commercial coal mining bit. Do you reckon it will
Mm-hmm.
elicit enough and more response from global companies to make a beeline to India because of the price differential and the reforms, etc.? Or do you think let's wait and watch?
So, if you look at the first out of the 40 coal blocks which were put up for auction, 19 coal block bids have come in, and mostly they are domestic mining companies or or Indian companies which have experience in when it comes to mining any sort of resource. So, at this point of time, it's more of the domestic players, and frankly, we have enough expertise within India to basically make a call on what is the best approach
Okay. I think I'm facing a bit of an issue with the connectivity of the guest, but it still is a very interesting conversation, viewers. Keep in mind. I mean, just think of it this way. All of us have been tuned to thinking that India is taking all the steps to being a less import dependent economy, but just going by pure demand and supply factors, these equations in the natural resources, particularly metals, LNG, etc., might change. Sorry, Pinakin, you're back. Just making this point. I think you were mentioning that it's largely domestic oriented companies which are
Yes,
showing response
yes,
right now.
sure, yes. Domestic companies, I think, and the expertise resides over here to take it up further.
Okay. Well, let's wait and watch how that shapes up. So that is part one of this conversation. Now, Pinakin, you again, I'm not asking you to choose the first amongst equals, but I'm just asking you.
Sure.
In your note, speaks about coal, LNG, metals, and all sorts of them. Where is it that you believe the demand supply equation could be the most stretched? Ceteris paribus. Um, Pinakin, if you can hear me, I was just asking you about where do you think the demand supply might be the most stretched? Would it be metals? Could it be LNG? Could it be coal over a period of the next 5 to 10 years? Okay, I think we'll just wait for one more time for the guest to be able to tell us this very important thing. I would love to read from him about the commercial capex plans or the capex plans that companies have. And as I said, the one last question that I would want to ask him would be what's the impact on the ancillary players? Because keep in mind, viewers, the as much as these demand supply mismatches aid the larger behemoths in the Indian landscape in the natural resources space, ancillaries which work for them, and if the work is the trajectory is higher, might actually benefit a lot. So you'll actually have a lot of these mid-sized ancillaries if things go as per what JPMorgan is suggesting. That all of those two would actually have a really good run. Also, keep in mind that metals per se, as much as we would like to scoff at how they've not been wealth creators, if you frankly look at the moves from the lows of March 23rd until now, or until at least end September or end October or mid October, metals were amongst the largest gainers. So, as much as we would like to think that the rally has been led by certain mid caps and Reliance Industries and some uh, FMCG names, the truth couldn't be further from the truth. Some of the metal names have been exceptional wealth creators in the last 3 odd months. If we get the guest back, I would just like to ask him this one last question on what is his thought on how do the ancillary plays work out in a scenario like this. But that would be the very interesting bit as well. This is how some of the NSE Metal Index companies have performed. It's a good data point. So I thank my producer for bringing that up. Again, as you can see, uh, JSW Steel with that 40% uptick, and this is point to date. I mean, there's a 3 month performance. If we look at the numbers from March, and if we ignore the last few bits of a pullback that has happened in these stocks, we'll actually see that some of the metal stocks have done really well. But yeah, the ancillaries too are sitting very, very pretty. The other, this is of course the 6 month period, and as you can see, 103% for Jindal Steel and Power, JSW Steel 71%. Some of the other Tata Steel about 37%. So some of these companies have done really well, and some of them have outperformed the performance of the Nifty as well in a meaningful way. AP Apollo, of course, is a converter and is therefore strictly not a resource company, but it's a part of the NSE Metal Index and therefore finds its way onto the chart that we were trying to say. But the index having done 25%, some of the other companies have outperformed quite quite amazingly. So that's essentially the key point when it comes to the metal space. Anyways, I unfortunately we're not quite getting the login back from the guest connectivity issues. But this was largely the sum and substance of the JPMorgan report. Okay, do we have him back? Yes, we do.
Yes,
Pinakin,
sorry, Neeraj. Yes,
no, no, completely fine. But okay, we just make it the last couple of questions. One of them
sure.
is if indeed this import parity or import disruptions are to happen, if I can request
Mhm.
you to try and choose the first amongst equals, where is it that you believe the demand supply mismatches would be the most stringent and the most evident?
Sure. So if you look at the commodities, India is already an importer of LNG, coal, and oil. What India is not an importer so far in a material way on a net basis is steel and aluminum. And over the next 2 to 3 years, especially with the government's focus on infrastructure spending, steel is the one where we see it materially tightening. And you have the companies which have very high debt on their balance sheets, which means that the equity value could reflate much higher. So to that extent, steel is where we think it could tighten or shift from where we are, followed by aluminum. And then towards the second half of the decade, we could also see that happen in refining products as well.
So, Pinakin, safe to assume, I'm not asking you for recommendations, but safe to assume that
Mhm.
by and large, you would be very bullish on the metal companies within your coverage universe.
Yes, our view is these companies are behind the capex cycle, operating environment is improving, policy framework will be supportive, and most importantly, valuations are near 2009 lows. And many of the companies in our space have dividend yields more than price to equity, price to earnings multiples. And these are earnings which are below mid cycle. So clearly, you have investor aversion to this space at extreme levels, even as the longer term operating environment looks to be improving.
And the timing doesn't seem to be too bad either. As Pinakin said,
Yes.
they've received number of queries about whether they are too early in the cycle, and he doesn't believe
Yes.
so. Okay,
Sure.
one last question. Again, I don't know
Mhm.
whether your coverage universe would have some thoughts about the broader end
Mhm.
of the spectrum, and maybe some other team member covers it. I don't even know that,
Mhm.
but I'm just
Sure.
asking you, do you believe as a natural extension of your
Mhm.
belief about what these companies are likely to in the demand supply scenario, that the ancillaries could also have a big bonanza over the course of the next decade?
So the way we look at it is that if you're going to import more stuff, and these are large, moving items, steel, aluminum, you will need to develop an ecosystem which would basically allow you to import more. That ecosystem exists in some of the commodities like LNG. It does not exist in a big way for some of the other commodities. So as you move towards importing more, that ecosystem which will include new kinds of businesses would have to come up, and that's what will support some of the imports to take place.
Well, this was a really nice interaction, much different, Pinakin. Not too many people look
Sure.
at cyclical commodities from a 10-year
Sure.
perspective. So I'm happy that you've
Yes.
done that, and thank you for
Sure.
sharing this with us.
Thank you for having me over here. Thank you.
Now, the pleasure was ours. And viewers, I thank you for joining in today. It's a very interesting conversation and a very interesting way to look at the resources space. I urge you to try and revisit this once more to make under sense of what Pinakin Parekh was trying to say. Happy investing, and thanks so much for tuning in to Talking Point.